I do want to get into the technicals with you, into the data. I know you have a lot of charts to walk us through. Before we do, though, I'd just like to kick this conversation off with a question I ask every guest when they first come on. What's your current assessment of the global economy and financial markets?
The Fed is trying really, really hard to accomplish their objective, and they are going to succeed no matter what. And that is the big factor. There are a lot of things that the economy has going in its favor, but it's got the Fed going against it. And if you were picking sides for a basketball game, you'd want the Fed on your side. The Bulls don't have the Fed on their side. So it's going to be a rough year. However, for a trader, that's a great year. If you can buy low, sell high, rinse and repeat over and over, you can have a wonderful time. And so I'm not having a bad year so far, because I understand where the pitfalls are and where they're supposed to be, and I know how to recognize them. And that's the key that I've found. Some people can just wing it and ride the trend whichever way it's going, and when the trend reverses, they switch with it. I used to be a pilot. I was an Army helicopter pilot for 11 years. And I like to have a flight plan. I like to fly the plan. I like to be ready for things that come along if the flight plan doesn't go as it's supposed to. But I am much more comfortable knowing what's supposed to be happening and having indicators that'll tell me that. And then also having indicators that'll tell me something's going wrong and you need to bail out.
I'd like the audience to start with an understanding of the lens that you look through. Your firm developed an indicator called the McClellan Oscillator that's gained wide use across a lot of financial analysts who use technical analysis. Can you explain what the oscillator is and how you use it?
Yes, and it wasn't actually our company that developed it. It was my parents all the way back in 1969 when I was had graduated from training wheels and was interested in playing with Hot Wheels. I had no contribution to that work at all. But my father was a business major at Claremont Men's College in Southern California, and he met my mother, who was a mathematics major at Pomona College right next door. And it really took the work of both of them to figure out how to do it and what it meant. They had been followers of a guy named Pete Harlan in the 1960s. He ran a service called Trade Levels, and Pete Harlan was an actual rocket scientist who worked at JPL. And he was the first guy west of the Mississippi to ever use a computer for stock market analysis, because he had access to one when they weren't busy using the computer during the daytime to calculate rocket trajectories. He would get on board the computer with his stack of punched hole IBM cards at night and enter stock market data and do analysis that way. Pete Harlan was the guy that introduced exponential moving averages to the world.
That is such a fascinating origin story. Thank you for sharing it. And wow, there's so many big brains involved in that. It's got to be a lot of weight to carry on your shoulders, Tom. All right, well, look, Lynn, let's just cut to the chase. Like, what is the oscillator telling you these days?
Well, the oscillator is a confirming indicator. It does have some predictive abilities, and it's not the main predictor that we use, but it's a great for confirming that what we hoped was going to happen is happening, or no, something else is different that's happening, and you ought to pay attention to that. Right now, the breadth numbers that we're seeing are not that great. They were great in January. We had a wonderful January with lots of breadth thrust signals. Walt Deemer's breakaway momentum triggered, Wayne Whaley's breadth thrust triggered, a couple other signals that look at the strength of AD data, advanced decline data triggered in January, because we just had a hugely robust counter trend rally with all the concentrated buying happening in January, and that resulted in some big breadth numbers. But I don't think that unlike other times when we see that kind of thing, I don't think it's signaling a true initiation of an uptrend this time.
Okay. Look, I've got one of your reports here. As I skim it, it does look like the outlook is currently pretty bearish. I think the most positive one here is neutral right now. But it's neutral to bearish on stocks, bonds, and gold here at least. I'm curious, does the oscillator, like what window does the oscillator help you with? Is it just short-term movements? Can it be longer term periods as well?
Well, that's an interesting question, and there's lots of ways to use it and lots of ways to get answers from it. And the more you use it, the more answers you see. The interesting thing about its development was that back in the 1960s, brokerage commissions were roughly 3% on the entry and on the exit. And so people didn't trade stocks. Retail
It was so
investors
expensive,
didn't.
yeah.
You invested. But what my father had noticed was that probably 2 or 3 times a year, there was a great opportunity where if you basically bought the low, what you would do is you would get a much higher dividend yield on your investment. So he wanted a way to find where are those 2 or 3 times a year that you really want to be buying those things, not trading every day or every week, because you couldn't do that effectively in the 1960s. And so it's useful for that when it shows you a really oversold extreme, which it is showing us a modestly oversold extreme right now, but not in a way that interferes with the continuation of the downtrend.
All right, fascinating. All right, well, look, I know you put some slides together, and maybe now is the time to sort of dive into them to see your general view on what all the data is telling you, and then we'll maybe talk about kind of what that means for the average investor here. I also do want to ask a question. Maybe I'll let you determine whether to answer it now before the charts or afterwards, which is, you talked about the Fed being the LeBron James on the basketball court, right? How much does the macro figure into your analysis when you package everything together versus just looking at what the data is telling you?
It factors a lot and more because the big macro players are, number one, the Fed, and number two, all the banks that the Fed works for. And when those two are in opposition, you can have an interesting time. But when they are working together, and they are working together this year, it has an even more powerful effect. And so I think that the global macro, and especially the U.S. macro, because we are such a big part of the global financial markets. So you can, if you want to know what any country is going to do, you can pretty much look at the U.S. and what it's going to do, and the other countries are going to tag along. It's very big, and we'd like to get the answers ahead of time. And there are a lot of tools that we've found in having a newsletter for the last 28 years that give us good answers. And so I thought your viewers would like to see a few of those that we use.
Great. So I'm sure they do, and we'll get to that in one second, but now I got to ask a follow-up question since you gave such an interesting answer. So the Fed is basically taking liquidity out of the bathtub, right? It's aggressively hiking rates, and it is doing now QT, right? When you say the banks are on the same team as the Fed right now, are you basically referring to the fact that they are increasing credit standards, and therefore that is slowing liquidity into the system as well? Or are you talking about something else?
That's part of it. They are responding to their deposits versus lending. They're responding to what interest rates are doing. They're responding to what the Fed is doing. They're responding to what they think the Fed is going to do. They're responding to a bunch of different things. But we try to look at the whole river of liquidity and see what it is doing. And it's not going to be a good time until about October of this year.
Okay, and that's because you think liquidity is going to continue to contract until at least then?
Liquidity really matters. It won't contract in a straight line. There'll be some ripples, and that's where the fun is playing the game of buying low and selling high to catch what the ripples are doing. And there's going to be some ripples, but there's going to be also some major turning points this year that I brought some charts to discuss.
Then let's go through. I'm going to bite my tongue because I have a couple more questions on that, but maybe you'll answer them here in the charts.
Hopefully you're seeing my screen and we can get started.
See it just fine.
All right. Well, somebody said that the number one rule of persuasion is attention, and so I like to start with a little bit of humor, just to make sure everybody's watching. And the next little bit of humor I got from the late Ian McAvity. He was a great stock market analyst for many years who wrote a newsletter called Deliberations. And this was one of the slides that he liked to use in his PowerPoint presentations. It says, "How's your day going?"
Now, is that supposed to be a parable for today's investors? Are they driving in the convertible right now?
Well, and if you look at the convertible, everything looks great. Everything looks fine if you're not forward looking. And so if you're looking at the economy in the rearview mirror and GDP is growing and unemployment is low, everything looks fine. You have to be forward looking to avoid trouble in this market. What's supposed to be happening right now is that we're supposed to be in a huge bull market because we are in the third year of a presidential term, and the third year is nearly always an up year. You have to go back to 1939, which coincidentally was the last time there was a major invasion in Eastern Europe when the Wehrmacht was marching through Poland in 1939. That was a bad year for the stock market. 1931 was the third year. It was also a bad year. But generally speaking, when you don't have a condition like that, the third year of a presidential term is an up year. I synthesized this. Other people have done this. I call it the presidential cycle pattern. I just chop up the stock market into 4-year chunks of time and average them together. And the first 2 years are generally flat and sideways. And that's kind of what we had in the current presidential term. We're now in the third year. And I count these years as starting on November 1st, because that's when the election is. And it's a little bit of a misnomer to call it the presidential cycle pattern, because that seems to give a lot of credit to whoever's president for whatever happens. And that's misplaced because the president doesn't have very many levers of power in terms of the economy. But the way that the stock market behaves in relationship to the political calendar matters. And so that's why the 4-year cycle gets called the presidential cycle pattern. So we're supposed to have this big, huge bull market in the third year. It's supposed to be straight up at this time of year. A little weak spot in February, like we have just seen, and then we get back to trending higher. I don't think that's going to work out this way this time because of the constellation of macro forces that are aligned against the stock market. And when it comes to the stock market, it's important to note that liquidity is real important. So if you want to know what liquidity is doing, you don't look at the big cap stocks. You look at the canaries in the coal mine. And the best one of those that I've found lately is looking at what high yield bonds are doing. This is an advanced decline line for corporate high yield bonds as ranked by the rating agencies and as tracked by FINRA. They publish this data every day. And the advanced decline line is a cumulative total of all previous numbers for the daily advances and the daily declines. And so if you have more advances than declines one day, the line will go up. If you have more declines than advances, then it'll go down. Generally speaking, these high yield bonds behave a whole lot like the stock market, more so than like treasury bonds. And so, but they are terribly subject to liquidity forces. These are the marginal investments that are hardly worth investing in unless you really want to take a risk. And sometimes that can work out great, but when liquidity starts to dry up, these are the ones that get taken out behind the barn first and slaughtered. And so when these guys are doing badly, that's a sign of trouble coming that's going to come around and bite the big cap stocks. We've just recently seen this advanced decline line was acting strong to start the year, but it has fallen below a key moving average, the 5% trend or the 39-day exponential moving average, fallen below its rising bottoms line, which the S&P 500 has not done yet. It's saying liquidity is weak and there are problems.